Greetings, Jonathan Camarda, Chief Investment Officer. Hopefully you're all doing well. Well, I'm sure you're also today as inflation has risen to 9.1%, the highest level it's been since the early 80s, mostly attributed to gasoline costs and such. Now, as we move forward, some of those may be adjusted. So you saw where the White House kind of tipped the hand a day before, so you knew those numbers might be high. We're looking at multi-decade high. Now, the one thing that we would look at, however, is that we've seen energy and commodity prices since June come down pretty hard. And we've also seen what we call the 10 and 2-year spreads on treasuries, which in English means the pre-recession, perhaps radar, quote unquote, indicator. And those have come pretty flat, showing again, as we are looking at still recessionary winds, even as we look back at the hot numbers, going back to last month on the inflation data. So what does all that mean? Well, the market sold off heavy, for example, today. Today's July 13th. You may be watching this on the 14th. But as we kind of move from when that data came out, the market's bounced and then pretty much retraced into a more docile downward trend. That being said, trend-wise, the market is still in a downtrend as we are in a bear market since the beginning of the year. Now, however, there have been signs of some buoyancy as rates have actually come down over the last few weeks. Treasuries have become a little bit more attractive risk-reward scenario where you've seen in many of your strategies we've taken advantage of. And that's also given some breathing room for tech companies like Apple and such that you've seen bounce. And some of you have exposure, albeit a small amount, in technologies, again, in your sector rotation, macro momentum, as well as global macro strategies as well. Now, of course, with all this being said in an inflationary environment, it's been king dollar, and most of you have had to some percentage or not participation there to help on our active capital preservation strategy, which is down in mid-single digits this year. The U.S. dollar has been essentially the weight bearer there in helping navigate the waters, and it continues to be as you look at foreign currencies like the euro, the yuan, the yen, and as such, very weak on a relative basis. So that has also drawn capital here, as well. And generally, that's the case, as we've discussed, when a federal bank, generally raises rates and tightens, right, makes borrowing harder. The currencies generally have an appreciation because of foreign capital flows in this direction. Now, one area we haven't had a lot of exposure is emerging markets, although we've tiptoed into certain scenarios in Latin America before it sank in our, again, sector rotation and macro momentum strategies, as well as Chinese technology, again, which was attractive for a while and has started to submerge with regulations and as such, and shutdowns and non-shutdowns and back and forth ping pong ball going on over there with geopolitical strategies. But other than that, most of our equity positions and all of your strategies has been more domestic. And even, Europe, again, been horrible when you look at the EFI, the European Austriatic Far East Index, as well as they call it for the developed countries, has not been a picnic. Now, our concern on emerging markets longer term is there. They've had somewhat of a reprieve recently because as energy prices go down, since they import a lot of energy, that has helped them out. However, the strong dollar has been killing them, and essentially think of it like this: since emerging markets, again, most of their foreign debt is denominated in dollars. When the value of the dollar goes up, the credit card payment's a lot higher. So thus, that's the reason, in a nutshell, it took me a while to get there, right? Why you haven't had a lot of emerging market, except for the proverbial parsley on the dish that you have had exposure-wise. Another real delineation between us and most money managers that we see every day, the allocations that they just have these heavy weights still in international emerging markets, and they actually rebalance when they go down. And go right back to the higher percentage on a longer-term allocation scale. So we'll save that perhaps for another session, and you guys can let us know how you guys feel about that. But that's really where you appreciate the true tactical nature of the Camarda Wealth strategies, in the such that we don't have a dogmatic rebalancing system, that we just keep buying what's going down and selling what's going up, assuming that we know when the proverbial knife is going to stop falling. So before I get off on a soapbox, maybe I already have, as we move on, the allocation right now as we sum up in this environment, which is inflationary, looking in the rearview mirror, recessionary, looking forward. As I mentioned, the forecast for rates, by the way, 1% now, 100 basis point increase at the next meeting is now a higher percentage than 75 basis points. And that's pretty hot. That's a fastball for the market. However, when you look into 2023, it still is for rate cuts. So we shall see, as again, we definitely have a juxtaposition between the reef and the fall off, so to speak, in the continental shelf, if you will, of what we're actually dealing with here. So as we look forward, we are still pretty heavy cash across the board in the book in the 40% range. Hedge strategies as well on next largest holdings, US dollar. And then we have scant positions in various sectors that we've been really playing around, in this mean reversion that we've had in an overall downtrend, right? So that's really what we're looking at here. Again, it's been heavy cash, heavy hedges. Even on a day like today and on highly volatile days, you see that, even though we may be bleeding, it's a lot less. And the whole goal, again, is to stay solvent when things turn around. When we're looking up at the proverbial peak to where we want to get back to, you want your base camp to be at a higher level. Again, it's not perfect, just like the ever-changing clouds in the sky. That is what the market is dealing us. However, as again, your individual risk situations or cash flow needs based upon if you're just retiring or have had a change in circumstances, please reach out to your personal wealth advisor, discuss that with them. And so therefore, they can also ascertain if within a strategy that we're working for you on a macro level is also working with the idiosyncrasies of what's going on in your life to make sure that that risk appetite is a perfect fit. With that being said, you probably had enough of me by now. I can tell when I've worn out my welcome. I usually get the nod from my wife, but I'll just assume I'm getting the nod from you guys now. So we appreciate your time, your patience, most importantly, your trust. Other than that, stay frosty. And until next time, Jonathan Camarda.